Hello, everyone. My name is Josh. I am from the Ladder Up Tax Clinic. And as you may know, it's tax season, which is a time that can be a little scary, a little overwhelming. And so the goal of today is to demystify taxes and the tax filing process as much as we can in the course of a little under an hour. And also, we're going to dive more specifically into what it means to be self-employed, to be a gig worker, and then how that affects your taxes as well. So let's get this show on the road. Okay. So first, I wanted to just do an overview of Ladder Up services. We have three prongs that we offer to people, kind of in the financial services tax world. The first of those, kind of our bread and butter, is the tax assistance program. And through that, we offer free tax preparation to folks whose income, whose family's income, whose household's income is under $40,000. That number is a little bit flexible. So if you're not sure if you're going to be above or below $40,000, I'd encourage you to come in and, especially if it's not a crazy busy day at the tax site, we'll probably be able to get that return done for you. I do want to note this year, this is a change to our programming. We are not preparing Schedule C this year, and that is the form, the tax form that is associated with being self-employed. So if you are self-employed, if you have cash income, if you're a gig worker, if you're getting a Form 1099 NEC, for example, unfortunately, we would not be able to help you this year with that return. In lieu of that, I recommend something called AARP Tax Aid. It's not just for senior citizens. It can help a wide range of folks who have low or moderate income. And they have just really fantastic volunteers who are well trained and can work with you one-on-one to get your taxes filed. Also, there's something called IRS Free File. That's a program where if you go to the IRS website, they will connect you with guided tax software for free that will allow you to prepare the return yourself. So there will not be, one-on-one personalized human help during that process, but the software is developed to kind of guide you through it, ask the right questions to prompt you to enter an accurate, complete return, and that works well for a lot of people too. So IRS Free File, AARP Tax Aid, great options if you are self-employed and have that Schedule C that you'll need to file with your return. We also have our tax clinic. That's the program that I'm involved with. And we represent and counsel folks who are in controversies with the IRS or the Illinois Department of Revenue. So this goes a little bit beyond, just filing a tax return in the normal course of business. And this actually comes into play when there is a dispute as to a tax return or a lack of tax return. So maybe you're getting audited by the IRS, maybe your refund is under some scrutiny, you're being held up, maybe you're the victim of tax-related identity theft, you need to clear that up. The clinic can help with that. Or, even if there's not a dispute as to how much you owe, if you simply owe more than you can afford to pay and need help navigating what we call collection alternatives available from the IRS, we can also help you with that. That's also a controversy that we deal with all the time. So that's the tax clinic. And then we have our financial capabilities program, sometimes referred to as FinCap. And that kind of breaks down into two things. There's the college success track, which is focused on helping folks effectively fill out the FAFSA and otherwise gain access to financial aid for higher education. And then there's the adult literacy track, which a little bit more broadly helps folks develop skills around budgeting, understanding credit scores, and just other elements of setting yourself up for a nice, stable financial life moving forward. Okay, so before we get into the nitty gritty, I think it's just helpful to take a big step back and ask, what are taxes? Taxes are a kind of payment that we all make, and we pay it to the government. And you might ask, why does the government need my money? Well, the government needs our money because the government does a lot of things for us, a lot of things that help everyone, more or less in our country. So they are responsible for building bridges and maintaining roads. They're responsible for running our schools. They fund the fire department that helps people in emergencies. And so by paying in these taxes, we are creating a government that can provide those services and just make for a better, more secure country. So even though there's kind of a culture in our country of, I want to pay as little tax as possible, I hate taxes, I like to try to have a little bit of pride in paying taxes because, again, I'm doing my part as an American to help fund the really important services that only our government can provide to everyone. Taxes, we pay them as we go. So if you're an employee, for an example, taxes will be withheld from your paycheck and sent to the government each week or each 2 weeks, however often you get paid. But we only file a tax return reporting all of that and kind of, adding all that up once a year. And we do that each year around tax season, which is February through April. Our return is due on April 15th, and we use the forms that we get in January and February, like a W-2, like 1099s, just other documents showing what income we have. We use those to file that return by April, by that tax day deadline. There are lots of different types of taxes. You might have heard of property tax, if you own a home, sales tax if you buy just about anything, excise tax. Those are a little more wonky, a little more nerdy. But what we really are going to talk about today is income tax and payroll tax, which you also might hear referred to as FICA or self-employment tax, depending on the context. So income tax, it's kind of what it sounds like. You might owe it on any economic benefit you receive. And again, that's really just a fancy way of saying income. And we'll break that down a little bit more later. But the rate of income tax depends on how much income you had during that year, during that calendar year where we are doing your taxes. So right now, it's early 2026, but our taxes are about the calendar year of 2025. So we are reporting and adding up all the money we made from January 2025 through December 2025, and we're figuring out how much income tax we have on that income. There's also a special capital gains rate that applies to investments. The thinking behind that is that it's a little bit of a lower rate to incentivize and encourage people to make investments and then hold those investments for over a year, so relatively long-term investments. And then there is the payroll tax, and that is a tax on earned income. And like I said, income tax funds a lot of things. It funds bridges, it funds roads, it funds firefighters. But the payroll tax is specifically to fund Social Security benefits and Medicaid benefits, Medicare benefits for when you reach a bit of an older age, typically. If you are an employee, you might not have heard a lot about this tax because you don't really have to think about it. The employer, who's employing you will automatically withhold half of it for you. You don't have to do anything. And then the employer will automatically pay the other half themselves. So there's really no need for you to think about it in that case. But if you are self-employed, you still need to pay this tax, and you're going to have to calculate it and pay it yourself on a quarterly basis, which we'll talk about in detail later in the presentation. So this is the tax return form that most of us will file. It's called Form 1040. I always wondered, why is it called Form 1040? That's kind of a random number, and it is a random number. Basically, back in the day, like 100 years ago, when the IRS was making this form, the last one they made was called Form 1039. They called the next one Form 1040, and voila, now it's a fixture of American taxes and the tax community. I do want to differentiate between, because this is something that a lot of people get confused, a tax refund versus a tax return. So a tax refund, that refers to the money that you get back from the government after you file your taxes and report that you actually paid too much and want that money back. That's a tax refund. A tax return, that's not money you get back. It is just how we refer to the form itself that you are going to file. So this 1040, and then any other schedules and attachments, which are like extra pages to kind of show your work, that is the tax return. You might get a tax refund as a result of that tax return, but those are separate things. And I know this form can look a little scary. There's a lot of words, a lot of lines. How do I fill them in? How do they fit together? Don't be too scared, because for one, a lot of these lines you won't fill in at all. They're there for more complex returns, and a lot of them we just won't have to know anything about at all, frankly. And the rest of them, we're going to break it down and, like I said, try to demystify it a little bit. So let's get into it. So here is our roadmap. And the first thing we're going to talk about is gross income. That is just starting to think about, what did I make during the year? And is the IRS going to be interested in it as something that it might apply income tax to? So some examples of income, I won't go through all of them, but I think a key takeaway here is that most income, most money that you can receive throughout the year, most of it is going to be considered income by the IRS that might be taxed. The rule of thumb is that any income is income unless there's an exception, which we'll get into in a sec. One thing I do want to touch on specifically is unemployment benefits. These are considered potentially taxable income, which surprises a lot of folks. Honestly, if I were making the tax laws, I'm not sure that I would tax unemployment benefits. I think it's a little bit strange, but I don't make the rules. I just have to follow them as best I can and advise people on following them as best I can. And so, like it or not, unemployment benefits are income that might be taxed, and so you do have to report those on your tax return when you file. Some things that are not considered income, though, for these purposes. If you get a gift from someone, you don't need to report that. That's fine. There's no tax implications of that. There are some circumstances where, the person giving you that money, if it's like $1 million, they might need to pay some tax on it. But I don't think most of the people here, certainly not me, is going to be getting $1 million gift anytime soon. And so you don't need to worry about that. Life insurance proceeds, also not taxable. You don't need to worry about those. Most alimony payments are not taxable. And then also child support payments are generally not taxable because that income is considered for the benefit of the child as opposed to the person who's going to be filing and potentially paying taxes. Let's also talk a little bit about earned versus unearned income. This is another thing where it is kind of what it sounds like. So earned income, that's when you are actively involved in the work that results in the money. It might be services that you provide, it might be goods that you are selling. So for example, let's say you are a chef, you work in the restaurant industry, maybe you get paid for going in for the lunch shift and working on the line that day. That would be earned income. Or maybe you're in the business of buying and then reselling for a profit, pots and pans and other kitchen equipment. That would also be earned income, whether you're doing a service or selling a good. And in either of those cases, you might be an employee or you might be self-employed. Either of those can be earned income, and we'll talk about that in detail later. Earned income, like we were saying, this forms the basis for that payroll tax or self-employment tax. And the amount of earned income you have, it determines how much tax you're going to pay toward that. And it also will determine down the line what you get in Social Security benefits. So it's important to report this accurately so that the government knows how much you've worked, how much you've earned, so they know how much to pay you in Social Security down the line. Unearned income, this is where you are not actively involved in earning the money. So it's passive income. The way to think of this is you don't really need to do anything to be entitled to that income. So let's say that I have some money, I deposit it in the bank, and then I go away for a while. And because it's in a bank account, it earns interest. That is income to me because it's money I didn't have before, but I didn't really do anything. I just let it sit in the bank for a year. I didn't do anything during that year that would, create the interest except making the deposit. So that is passive unearned income. Similarly, Social Security is considered unearned income because even though you worked in the past to get these benefits, once you are entitled to the benefits and once you determine I am retiring, I am taking the benefits, you get those for life. You don't have to do anything at that point, and so it's unearned income. Both of these types of income, though, can be taxable. So don't have the thought that oh, if it's unearned, it must not be taxed. That's not how it works necessarily. And so there are other rules that apply to whether it's going to be taxed beyond whether it's earned or unearned. Okay, so we've talked a little bit about income, what kinds of income the IRS might be interested in. But before we actually determine how much tax you're going to pay, one thing we get to do is we get to make adjustments to that income. And these adjustments are going to bring our income down and therefore bring our taxes down. So adjustments are good. Okay. So like I said, adjustments reduce your adjusted gross income, which therefore reduces your tax. And just some examples of this, this includes the student loan interest deduction. So if you took out loans to go to school and are paying those back, any interest you pay on those might qualify you for a deduction. Certain retirement contributions. So let's say I made a contribution to a traditional 401k. What that means is, say that I make a $1,000 contribution to that. That means I get a $1,000 deduction this year because that money is actually going to be taxed when I take it out down the line, ideally when I'm over the age of 59 and a half and have retired. So that's how a retirement contribution can be used as an adjustment. Capital losses. So let's say that you buy a stock and then sell it years later, but sell it at a loss. That might allow you to claim this adjustment. Educator expenses. So if you're a teacher and you pay for a classroom supplies like books or pencils or whatever the case might be out of your own pocket, which unfortunately, a lot of teachers have to do, that might qualify you for an adjustment. And then also self-employment tax, if you do pay that, then half of it can be removed from your gross income before the income tax is determined. There are also some more adjustments. We can't get into all of them. And also, I just want to say, this was just a very high level overview of these adjustments. There are, kind of nitty gritty rules associated with each of them. So you'll want to talk to a tax professional getting your return done just to make sure that you kind of check all the boxes to actually claim these. But if you are entitled to them, if you do qualify, you should claim them because they'll reduce your tax and put more money in your pocket. Okay, so we've talked about what income is. We've taken some adjustments to bring their income down, and we get to do one more thing before actually calculating the tax, and that is we get to either subtract a standard deduction, most likely, or some of us will subtract what are called itemized deductions. So let's get into that in detail. So like I said, there's basically two kinds of deductions for this step. There's the standard deduction and itemized deductions. And the standard deduction, the key thing to understand here is that it is calculated automatically. It's based on your filing status and your age. Once the IRS knows those two things, they tell you what the standard deduction is, and that's that. You don't have to actually have any expenses that you deducted. You don't actually have to prove anything about, expenses that you had. It's just standard. That's that. Itemized deductions, on the other hand, you do have to demonstrate these and actually prove to the IRS that you had these expenses. So you have to actually incur the expense, keep track of it, and then report it to the IRS. Certain kinds of deductions that can be folded into these itemized deductions include charitable donations. So if you make a donation to a 501c3 nonprofit, you can deduct that. Taxes that you pay to state and local entities, so state income tax, property tax can potentially be deducted as an itemized deduction. If you pay interest on a mortgage for your home, for your primary residence, that can count. And also, if you have large medical or dental expenses, those also might qualify you for this itemized deduction. And again, similar to last time, disclaimer, there's lots of rules involved with these. And so if you're going to go down this route, I recommend speaking with a tax professional about your particular circumstances. And the idea here is, again, deductions are good because they reduce our tax. We want that. And so the question is, can I get more from a standard deduction or more from adding up these itemized deductions? And since 2018, the answer for almost all of us is going to be, I'm going to take the standard deduction because in 2018, they passed a law making the standard deduction much bigger. And so very few of us actually have enough itemized deductions to get us above that standard deduction cap. So most of us will take the standard deduction and call it a day. And that's great because it's simpler for us, simpler for the IRS, and we get a nice deduction that's going to reduce our taxes. So I mentioned, the standard deduction is based in part on what your filing status is. So let's just go through those real quick. So single, and the number next to it, that means you get a $15,750 standard deduction associated with it. Single is kind of the most basic filing status. This is if you are unmarried, You have no dependents, so no one else besides yourself is financially dependent on you. If that describes you, you will file single. Well, let's say you're unmarried and you do have a qualifying person, a dependent who relies on you for support, who lives with you potentially, then you can file as head of household, which is great because as you can see, the standard deduction for the head of household is significantly bigger than the standard deduction for a single filer. But let's say, you are married. If you're legally married as of the last day of the tax year, and this is an important point, whether you are married for tax purposes, that depends entirely on whether you were married on the last day of the year. So let's say I got married in like November 2025. I would think, well, I wasn't married for most of the year. Can I just file single? The answer is no, because what matters is whether you were married on December 31st, 2025. So if you got married in November, you were married on December 31st, you would file as a married person. You can either file married filing jointly or married filing separately. There are, of course, some special situations, but generally we encourage folks, if they can file jointly, they should, for a few reasons. One of those is that you get a large standard deduction. The tax brackets are going to be a little bit more favorable to you, which means your tax will come down. And also there are some pretty important credits that you can claim if you're married filing jointly, but you cannot claim if you are married filing separately. So as a rule of thumb, we encourage folks to file jointly, but also there are some situations where married filing separately makes more sense. And so you should talk to a tax professional. Sorry to sound like a broken record on that. And then finally, there's qualifying surviving spouse. This will apply to you if you are married, and then, sadly, your spouse passes away during a certain tax year. And what qualifying surviving spouse basically means is that if that happens, and if you continue to care for a dependent in your home after your spouse's death, you can basically file as if you were married filing jointly for 2 years after the year in which that death occurred. Okay, so we talked about what income is. We took some adjustments to that income. We took a deduction, probably the standard deduction. Now we are finally ready to calculate our tax liability. And this is where the tax brackets come into play. And in terms of those brackets and that tax rate, there's two kinds of rates. There's a flat tax rate and there's a progressive tax rate. A flat tax rate just means that the percentage, the tax that is being taken out as a percentage is the same no matter how much money you made. So for example, the state of Illinois, they have a 4.95% income tax, which means that if you made $1,000, they're going to take 4.95% of it. If you made $1 million, they're also going to take 4.95% of it. That's a flat tax. But then we also have a progressive tax system, and that describes the federal income tax system. And what that means is that as you make more money, the percentage of it being taken out as a tax is greater. And the thinking behind this is that as people make more money, they have a little bit more money to play around with. They have more ability to pay into our tax system and still have money left over to buy the things that they need. And because of that, we think they should pay a little bit more and do their part to, again, fund those programs that are really benefiting everyone equally. Something to note here about the tax brackets, I think people get sometimes afraid of moving up a tax bracket because they think, well, if I go up to this next bracket, that means the percentage is higher. That means I'm going to pay more in tax and have less money left over, and that's bad. That is not true, though, because moving up a bracket, it only means that some of your income is taxed at that rate. So as you can see here, kind of with how the ladder works, if I make $100,000, then some of it will be taxed at 10%, some of it will be taxed at 12%, and then some of it will be taxed at 22%. But the fact that that last little bit is taxed at 22%, it does not affect the fact that the first part of it is only taxed at 10%. So moving up a bracket, having a good year, that's never a bad thing. It will never result in you pay, it might result in you paying more tax, but it won't result in you having less money because again, let's say even if I'm at the 22% bracket, that still means 78% of it is not subject to income tax. And so don't be afraid of that. It's a good thing to move up brackets, and you'll still keep a lot of the money that you earn. So now let's just do a quick kind of simple example of how this math works. We're going to say that our taxpayer here is 35 years old. They're filing for this year. They have no dependents. They're not married, which means they're going to file as a single person. They have no adjustments to their income to make it simple. And also they're going to take the standard deduction, which, like we said, most people in this day and age are going to do, and probably you are going to do. So we start with that income of $45,000. The standard deduction is $15,750. We subtract that from $45,000. That leaves us with $29,250 that's going to be taxed. And then we start just moving up the brackets. So like we said, the first $11,925 is taxed at 10%. That means there's a tax of $1,193. The next money, the remaining money is going to be taxed at 12%. That gives us a tax of $2,079. When we add the 10% bracket tax and the 12% bracket tax, that gives us $3,272. So that is their federal income tax liability for the year, $3,272. If math is not your thing, if that was very confusing to you, that's totally fine, because thankfully most people are filing with the help of tax software that does this math automatically. So you won't have to worry about it, but hopefully that was helpful just in kind of illustrating how this works and how the pieces fit together to arrive at what we're going to owe in tax. Okay, so now we're going to talk a little bit more in depth about self-employed people and the differences there and what you need to know about as a self-employed person. But before we get into that, it's helpful to just know what makes me self-employed as opposed to being an employee of an employer, of a company. And the key word here is the word control. So an employer has a lot of control over the details of your work. So they're going to tell you, hey, here's when your shift starts, here's when it ends, here are instructions for what you're going to do, here is the equipment you're going to do it with, here is our handbook. So they are controlling and directing you with a high level of detail. That suggests you're an employee. On the other hand, if there's not that level of control, and if the employer, or not the employer, I should say, the payer, whoever is paying you, if they give you a lot of discretion, a lot of choice in when you start, when you stop, how you do the work, what you're doing the work with, who you're working with, if you have control over that, then you are more likely to be a self-employed person, or you might be referred to as an independent contractor. If you are an employee, you fill out something called a Form W-4 when you start work. You might be familiar with this from doing onboarding in a new job. And all that form is doing is it's telling your employer what you expect to get in credits at the end of the year, tax credits, what you expect your filing status to be. And using that information, the employer basically estimates how much tax you're going to owe for the year. And then based on that, they withhold a certain amount each paycheck to make sure that you're paying that throughout the year and you don't have a big surprise bill at the end. And filling that out accurately is important because we want the right amount to be withheld each pay period. If not enough is withheld, then we're going to get a surprise balance at the end of the year. That's not fun for anyone. You might also have interest and penalties on top of that. And then if you're withholding too much, that's not the end of the world, because that's going to get refunded to you when you file your taxes. You'll get it all back. But in the meantime, you're not going to have that money. It might be harder to make ends meet, and you're going to have to wait for the IRS to actually process your return and give it back to you. So the goal, I would say, is to not have a huge refund, not have a huge balance at the end of the year, fill out the form accurately so that you're paying as you go, and there's no surprises. So yeah, let's just do another example to kind of drive home this difference between an employee and an independent contractor. So let's return to the example of the chef in the culinary industry. Let's say that the chef gets hired by Chili's. I really like Chili's, and Chili's says to them, okay, you're going to come on for the dinner shift. It's from 3 p.m. to 10 p.m. Here's your uniform. Here are the supplies you're going to cook with. Here's your supervisor, and here are all of our detailed instructions for how we cook our food here. Because in that case, Chili's is controlling the details of the chef's work. They're going to be an employee. Let's say the next night, the chef gets hired to do a special event, and the person says to them, hey, I'm having this big birthday party. I want it to be catered, but I'll leave it to you to decide the menu. I know you're the expert there, so you decide the menu. Just make sure to show up at 5 p.m. with everything prepared. And because you're a chef, like you can also handle the cooking supplies and stuff. I'm not going to pay for that. In that case, that sounds a lot more like an independent contractor because the chef has control over the details of their work, and can kind of fill that in themselves rather than getting explicit, specific directions from the employer. Okay. So when you are self-employed, and you might get what's called a 1099 form saying how much you were paid by the person paying you as a self-employed independent contractor, your taxes look a little bit different. And the key difference is that if you are in self-employed, you can reduce your income by claiming expenses related to your business. This is not the case with employees. With employees, what they make is what they make. It gets reported on W-2, and they have to report that full amount. But if you're self-employed, what you make is just the beginning of the story, and you can reduce that by claiming, again, these business expenses. It's important, though, that you know what you can claim, and the guiding light here is that the expenses have to be ordinary and necessary in your business. So, if you're a chef and you need to buy flour to make your food, then that's totally ordinary and necessary to making the food, and so you can definitely claim that as an expense. But if you're a chef and you decided you needed a rocket ship for some reason to try to fly to the moon, that wouldn't really make sense. That has nothing to do with being a chef, and so that would not be an ordinary and necessary expense. The details, can get a little, not every example is that clear, and so again, it can be helpful to work with a professional preparer to walk you through this and just make sure that you know what's an expense and what's not. But at a high level, what's important is that the expenses are ordinary and necessary in your line of work. So once you have taken your income, but then deducted those expenses, then you arrive at what's called your net income. And that net income will be income that you report on the Form 1040 for purposes of income tax. So you'll be charged, federal income tax on that net income after expenses. And then you'll also have to pay self-employment tax on that net income, and you'll report that on a different form called Schedule SE, self-employment tax. I kind of got ahead of myself here, but like we said, if you have an ordinary and necessary expense for your business, that can be deductible. Something to note is that you might buy something that is totally for your business, in which case you can expense all of it. But you might buy something that is partially for your business and partially just for you. So a lot of folks are rideshare drivers, and you need a phone, you need phone service to do that because you need to be connected to the internet to get new jobs and be connected to the map and so on and so forth and communicate with riders. So in that case, if you're using the same phone service for both, let's say half of it is to do Uber, half of it is just to call my friends and access the internet as a person, as a human being, not on work, then you can write it off partially. And if it's half and half, you would claim half of your phone bill as a business expense. And so some possible expenses, just to again give examples for a rideshare driver, the miles that you drive as a rideshare driver count as an expense because each of those miles wears down your car. You have to buy gas, you have to buy insurance. And one thing to note there is you can claim, gas, insurance separately. You can claim those each individually if you have the receipts for all the gas you bought, all the insurance, et cetera, et cetera. but most people find it easy to instead just use the miles driven as the measure of their car expenses. It's just a lot easier to keep track of the miles you drive than it is to keep track of every single expense and repair and gas and insurance for the car. So that's kind of an either or decision that most people choose to use their miles driven for. Maybe you buy water bottles to have in the back seat for your passenger. That would be a business expense. And like we said, phone service, maybe that's half and half personal, half business, in which case you would claim half of that as an expense. So, because you're going to be claiming these expenses and because it's very important that you claim them accurately and it's very important that you claim them fully, because again, they're going to reduce your tax and bring your net income to something that fairly represents how much you actually earned and netted throughout the year. It's very important to keep good records of these expenses and of everything that happens in your business. So a few examples of that. A business calendar really helps for just kind of outlining what it is you do on a daily basis that can help connect to what is an ordinary and necessary expense. Keeping a logbook of those expenses and the income itself. Again, it just shows how much you are actually netting and what is coming out of that to make the business possible. Mileage, we already kind of talked about. And then estimated taxes, when you pay those, that's the in advance payment of that self-employment tax and income tax that we have to do because we don't have an employer withholding that for us, which we'll talk about in detail later. But that's something you also certainly want to keep track of as you're going about running your business. So I do want to touch briefly on, like we said, if you're a rideshare driver or any number of other businesses, miles you drive for the business are a very important expense to claim. But it's important to know that not all miles count. And the thing to remember here is that miles count if you are driving from a business location to a business location. But if I am commuting, so if I'm driving like from home to my first pickup, that doesn't count. And if I'm driving from my last pickup back to home, that does not count either. So this chart is just kind of meant to illustrate that. And again, commuting miles do not count. Business miles do count when it's from business location A to business location B. And one of the charts here is just meant to show that, if your home is also where you do business, like let's say that you're a musician and your home is your studio, then that would count as a business location for purposes of determining, did I go from business location A to business location B? Here is a business calendar. Like we said, it's just about outlining what you do on a daily basis so that you have a sense of it, the IRS has a sense of it. This is income and expenses. So of course you want to have the date that you incurred the income or expense, a short description of it, just to remind yourself, and also to, again, draw the connection to why it is ordinary and necessary for your business as you've laid out in the calendar and in your business plan. And then of course, you want to keep the amount of the income, the amount of the expense, so you can, add that all up at the end of the year. And then here is an example of a mileage log. Again, you want to keep a log of where you're going and where you're coming from so you can confirm, yes, this was business to business. This counts as an expense for mileage purposes. And just a couple of tips. It's very helpful to keep separate bank accounts for your business and for your personal use. This will just, again, make it a lot easier to keep track of what business expenses are and how you can claim them. And then we just provided some resources. For mileage tracking, we recommend the Everlance app, the Gridwise app. QuickBooks is great for income and expense tracking. And then we have some links to free business counseling and then resources from the IRS. The IRS itself has a lot of really helpful stuff that can help you get started. But an overarching thought on all of this is that what's most important is that whatever system you choose for keeping these records, staying organized, what's important is that it works for you and only you know best, what works best for you. So it might be an Excel spreadsheet, it might be a paper and pen, it might be one of these that we've referenced here, but just make sure that you're keeping track in a way that makes sense to you and that you can stick with. And like I alluded to earlier, if you're self-employed, you're going to have to pay this payroll tax as what's called self-employment tax. And I included here that Schedule SE, which is where you calculate how much self-employment tax you're going to be paying. It's, as you can see, again, it's a little bit complex. Don't worry too much. The software that you're working with or the professional you're working with will do the nitty-gritty for you. But the high level takeaway is that it's going to be roughly 15.3% of your net income. So again, that's your income from your business minus those expenses that you claimed. It's going to be 15.3% of that, 12.4% of which is for Social Security, and 2.9% of which is for Medicare. And something to hammer home here is that paying this tax is not optional, and paying this tax, you might have to pay it even if you are not making enough money to have to file a Form 1040 generally to pay income tax. And the thinking there is that the requirement to file for income tax purposes only kicks in if your income is higher than your standard deduction. So at least, $15,750 if you're filing single. But the what triggers having to file a return for self-employment tax purposes is having $400 or more of net profit. So net income from your business, income minus expenses. So let's say that, I made $2,000 for my business. I had $1,000 in expenses. That means my net income will be $1,000. So that's below the threshold for having to file my income tax return, but it is, above the threshold of having to file for self-employment tax purposes. So you will have to file a return. You won't pay any income tax, but you will pay some of the self-employment tax to fund Social Security and Medicare. And again, it's not optional. So just driving that home, again, if your net earnings from self-employment are more than $400, you do have to file. And again, this is less than the threshold for wages in terms of being under that standard deduction. It's also less than the threshold for the requirement for the payer to issue a 1099 to you. So let's say that I work for, I'm a contractor for a bunch of different companies. They each pay me like $300 for each job. It adds up to, again, maybe $2,000. In that case, I would not get a 1099 from any of those payers because none of them paid me more than $600 individually. But because it would add up to more than $400, I still have to file that tax return, report that income, and calculate my self-employment tax based on that. Okay, so now that we've dove a little bit into self-employment, let's go back to our roadmap. We've talked about what income is. We've made adjustments to it. We've taken the standard deduction. We've calculated our tax based on those tax brackets. But there's one more thing to do before determining what our refund is or what we owe. And that is we need to subtract withholdings that we've already paid and also subtract tax credits that we're eligible to claim. So tax credits, let's first distinguish these from deductions. So a deduction reduces the amount of income you have that might get taxed, and a tax credit counts as one for one having paid tax. So these come into play after the tax is determined, and they count as if you had made a payment toward that tax due. So if you get a $500 credit, it would reduce your tax due by $500. If you have a $500 deduction, that would reduce your tax by less than $500 because not all of the income being deducted would have been taxed anyways, or it would not have been a 100% rate on that. Credits can be either refundable or non-refundable. If it's refundable, that means that it can reduce your tax down to zero, and then anything left over gets credited back to you as a check in the mail or a direct deposit refund from the IRS. If it's non-refundable, that means it can reduce your tax down to zero, but that's it. Any remaining credit just kind of disappears into the ether. So for example, if I had a $1,000 credit and I had $500 to pay in tax, if it's refundable, then the first $500 takes care of the tax. The next $500 comes to me in the form of a check or direct deposit. If it were non-refundable, the first $500 of the credit takes care of the tax. and that's the end of the story. I don't get anything back. Some examples of tax credits. In the non-refundable column, we have the child tax credit, which is generally $2,200 for any child under the age of 17 who is dependent on you and your household. The child independent care credit, you get a credit if you make payments toward a child care provider so they can take care of your kids so that you can work. And then the retirement savers credit, if you are beneath a certain income level and you make contributions to a 401k or other retirement plan, then you get a credit for that. Again, it's meant to encourage folks to save for retirement, even if their income is not super duper duper high. So it's kind of a win-win because you get to save for retirement, you get tax benefits from that, and you get a credit to apply to your taxes right away. So highly recommend that. Refundable credits. This includes the additional child tax credit, and this is, I always thought this is more confusing than it needs to be, but basically what this means is that so long as you work and have earned income, $1,700 of the $2,200 from the child tax credit can be refunded to you. So that's the additional child tax credit that's refundable, the refundable portion. And then the earned income tax credit. This is a big one. It makes a big difference in a lot of people's lives and really helps make ends meet. And this is just based on the amount of earned income you have, your filing status, and then whether you are claiming any dependents who have Social Security numbers. So that's the earned income tax credit. And a big part of what Ladder Up does is making sure that people who are eligible for that are able to access it. And then you also don't want to forget what you already paid. Like I've said, we live in a pay-as-you-go system. So if you're an employee, what that means is that based on your W-4, your employer is withholding taxes from your paychecks, sending those straight to the government each month or each 2 weeks, or whatever the case might be. And those are fully refundable. So like I said, if you withhold too much, if they pay too much in advance, that's all right. You'll just get it back. It's as if you had a fully refundable tax credit. But like we were alluding to earlier, if you are self-employed, if you don't have an employer making those payments for you throughout the year, you need to calculate and make those payments yourself on a quarterly basis, and those are called estimated tax payments. So estimated tax payments, they're required if you owe more than $1,000 in taxes for the tax year, and those are paid quarterly. So, basically in April, you make an estimated tax payment for your January to March income, in June for April to May, and so on and so forth through the end of the year. And like we said, paying these as you go is not optional. People ask us, well, can I just make one payment at the end of the year and take care of it then? The answer is not really, because if you try to do that and you're over $1,000 short on each piece throughout the year, you might get a penalty on top of the estimated tax payment that you need to pay. So I highly encourage you to use more information on the IRS website about this, about calculating it, making that payment throughout the year, and make sure you do that because, again, otherwise there might be some penalties when you go to file your tax return. All right, we are just about at the end, but another question we get a lot that I want to touch on is, if I don't make enough to be required to file, if my wages are below my standard deduction, or if I don't have $400 in net self-employment income, do I need to file? The answer is no, you don't need to file, but for a lot of folks, it's still really helpful to file, and there are a few reasons for that. Even if you don't have to file, you might still be entitled to a refund. Say if you had withholdings that you want to get back, or if you're entitled to the earned income tax credit, the additional child tax credit, so on and so forth, then you can file to get a refund even if you don't owe any tax. Filing a tax return can also help protect against identity theft. If there is a return already on file in your name, it's much, 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 much harder for someone out there with bad intentions to file a return for you for whatever reason they might want to do that. So it helps with identity protection. And then also the information on your tax return, such as your adjusted gross income, your number of dependents, and so on and so forth. That data is often relevant in determining whether you qualify for certain social services or benefits. So, applying for housing assistance, mortgage assistance, also unlocking the benefits that come from the FAFSA, Those are kind of dependent on accurate tax returns being on file. And also, having filed accurate tax returns can really help in immigration cases. Oftentimes, in the context of seeking a change in immigration status, the law, tells the people evaluating that to look at whether you have good moral character, and good moral character can be established partly by filing tax returns on time, and then also, eligibility for student loan repayment programs. Again, that's also dependent on an updated, accurate, adjusted gross income number. So there are a lot of benefits there too. And then one more note, we're right at the end. The process of actually filing your tax return can be done either by paper or electronically. If you can, filing electronically is a lot easier, faster, more secure. So we recommend that. But also, paper filing is still very much an option. Just remember to physically sign that return if you're going to paper file it, because otherwise they will send it back and it's going to be a headache. So just make sure to sign it. Or, if someone is going to help you file electronically, you will sign basically a consent form allowing them to file electronically for you. And as you're going through this process of finalizing the tax return, I just want to make it clear that, even if you're working with someone's help, you are responsible for what's on the return. And you are saying that what is on the return, again, is accurate, real, and you are basically attesting to that. And what that means then is it's just very important to ask questions if you're working with a preparer, just to make sure that you're on the same page, make sure that they didn't miss anything, make sure you understand what's going on. And then also make sure that if you're filing that way with someone's help, make sure that they put their name on the return if they helped you prepare it. A lot of folks run into trouble because they work with what are called ghost preparers, which are folks who, do a return, claim something that probably shouldn't be claimed, and then don't put their name on it, so the IRS can't trace it back to them because they know that they're doing something wrong. So be on the lookout for that. Make sure that you and the tax preparer are both signing it and assuming responsibility for it, because ultimately you both are responsible for it. That is all that I had. Thank you so much for listening. And yeah, I hope you have a fantastic rest of the day, and I hope that you're able to make use of Ladder Up services in the future. Thank you.